John, let's just start off. I mean, everybody knows the National Wealth Fund, but actually, for those that haven't kept up to date, like, how would you describe it? What's the remit, and has it been successful so far?
Thank you. Yes, the National Wealth Fund, government-owned policy bank that exists to support and amplify the government's industrial policy and strategy. We were born out of the UK Infrastructure Bank. Some of you might have been aware of that. But in October last year, we transformed from being the Infrastructure Bank to being the National Wealth Fund. So we now have a remit that extends across the full breadth of the government's industrial strategy. We've been given more money. Our notional capacity has gone up from £22 billion to 27.8. We've been given a very big risk budget, £7 billion. And we wake up every day looking for financing problems that will otherwise impair the government's industrial policy and strategy, including, of course, the climate transition.
And so you find them, no doubt. We'll talk about finding the problems. But Daniel, how do you work together, actually, at Barclays with the National Wealth Fund?
Incredibly closely, and I think it's been a really powerful partnership between the two institutions. I mean, Barclays, we have a focus on supporting the transition in the UK and in the other markets that we operate in. We finance now 162 billion in terms of sustainable and transition finance over the last 2 years. But there are many areas where it requires really pragmatic partnerships to unlock decarbonisation, transition. And that's where we've worked very closely together. So, for example, we've got a focus on investing in climate tech in the UK and internationally. We've got a fund of £500 million. And then if you take something like social housing, a very large part of the UK housing stock accounts for, I think, about 10% of UK emissions, just that stock. 15% of fuel poverty concentrated in that area. But it's actually quite a hard area to finance because retrofitting that takes very long tenors. And so, thanks very much to the National Wealth Fund providing a guarantee, we've been able to structure alongside a couple of other banks long-term financing. And we closed our first deal with Vivid, and that's going to impact 2,000 householders and 4,000 residents.
So, John, what's more difficult, actually finding the money or finding the projects?
The money's not a problem for us. We're fully resourced from a public sector perspective. I think that there's a market challenge to find the risk appetite. You know, we've got a risk appetite that's different to the market. We're not regulated as Barclays is, but we do need to put risk capital up against the risks we take, and we're taking roughly 4 times the amount of risk that the commercial banking sector's taking. The really nice thing about the Geopura and Zero Avia investments was actually the National Wealth Fund, or public money, came in after Barclays. We were later stage investors. So this is a great example of, you know, one of the kind of UK's national champions deploying balance sheet capital, taking risk early, doing something that then gives us the opportunity to leverage. The social housing thing, we loved that. I mean, this is one of the hardest nuts to crack in the UK's transition to net zero is our leaky, inefficient housing stock. I think too many have just decided cheap money is the answer. It very rarely is. It's more complex than that. But in this particular case, we were able to unlock, you know, working with banks, we were able to lock quite a lot of capital, which I think will really stimulate the supply chains, accelerate the development of the retrofit supply chains that in turn will service beyond social housing into the able to pay segment, etc. You know, the National Housing Federation estimated that the cost of retrofitting just social housing, £36 billion. Yeah. The state can't do that on its own. We can't do that in grants. So we have to find others to help fund it. So this was a really nice example of us working in partnership. We provide cheap capital and we leverage Barclays' network, its ability to relationship manage the social housing providers, the RPs. So great combination.
Can I pick up on this point, though, about is it money or is it projects, which is the sort of old chestnut? And as John absolutely said, it's really neither. It is more complicated than that. But it is about resetting expectations and what is the real risk and how do you structure against it. I mean, look, the money's there. I'll give you an example. We supported National Grid raise over $6 billion last year to invest in the infrastructure, grid infrastructure in the UK. Largest ever raise by utility globally. But then if you look at, let's say, the climate tech space, where we've spent a lot of time collectively on, you've got a growth area that's growing at 10% in the UK, much faster than the UK average. When we survey climate tech founders, 55% are hiring right now, way above, again, the national average, and yet 90% say they have problems accessing money. And so that is a great growth opportunity. The government's just recognised it in the industrial strategy. But actually, the risk appetite for many players in the market isn't there. And one of the things that I think by National Wealth Fund and Barclays working together is we're just showing, well, actually, you can do this smartly. And what that will hopefully do is catalyse others to follow.
But so what kind of returns are you looking at? I mean, if you look at risk return, but also scaling up, what are the metrics that you follow?
Well, so I think in terms of our climate tech fund, the 500 million that we're investing by 2027, that is absolutely looking at a commercial return in the same way another venture fund would look at it. And I think we've seen already, I mean, we've mentioned a couple, but we've invested in 22 different companies, majority, 80% are in the UK. A lot are going through tremendous growth multiples. And then when you look at on the financing side, there it's just a question of how you structure and what kind of returns you can get. We've talked about, you've got the big projects. We were in Net Zero Teesside last year, one of the biggest ever carbon capture projects, again, a leader from a UK perspective. But then also we did the first securitization for residential solar in the UK, supporting 28,000 homes get access to that. Very different risks, very different risk returns.
How should we look at defence, John?
Well, we're a government policy bank, so for us, defence is in mandate. The strategic steer that came to me from the Chancellor about 2 months ago specifically asked the National Wealth Fund to consider dual-use technologies where they can support our defence sector. So we won't be doing the heavy defence, building battleships and tanks, etc. That's not where we will be focusing. But we have a specific instruction from our shareholder to explore how we can be helpful in developing dual-use technologies where there's a defence application. So for us, as a policy bank with one shareholder, we don't have to think hard about whether or not that's a good idea. We just mobilise around it.
So can you give us an idea of what that looks like? Because is there a specific project or something where it's dual use?
There's quite a lot of activity in the drone space and in space technology generally. As everything we've learned through the Russia-Ukraine war, or recently in the Middle East, lots of applications for drones, dual-use applications for drone technology, but also the broader space industry, both the technology required to get things up into space, but then the technology.
I mean, we're actually learning some of the lessons around the climate tech and how we're thinking about that with innovation in the wider economy. And I think John's mentioned too, cybersecurity, another really important area. And I think coming back to the link to sustainability, I mean, energy security is such a key area of focus. And in Europe and the UK in particular, that doesn't have the benefit of large fossil fuel reserves, that is decarbonisation. That is the way that we're going to have low cost, more affordable, more predictable prices. And so this whole aspect of security actually plays into, I think, the sustainability agenda.
But do you think some of these, public-private partnerships get delayed because of either, distractions with trade and tariffs and wars, or just the U.S. retrenching?
There's no doubt that geopolitics can make a mess of business plans and can delay things. My lens is a rather narrow UK lens right now, and in some ways, the fact that the US is on a slightly different trajectory for now means that there will be opportunities that the UK will be afforded that it otherwise wouldn't have. So, we're being very proactive about making sure we're taking advantage of the opportunities. International allocators of global capital might be looking more favourably at the UK now on a relative basis than they would have been 12 months ago. We've got government with a large majority commitment to clear industrial strategy. So I think there's a lot for the market to mobilise around. So disruptions and dislocations elsewhere can be beneficial from a UK perspective.
I mean, I would echo that. We had a very big London conference a few weeks ago. We actually brought over a number of climate tech companies from North America, talking to investors here. We've seen an increase of interest in our investor clients re-looking at it. Investors and companies want long-term policy predictability. They want deep pools of capital. And I think one of the things that the industrial strategy hopefully helps signal is that policy continuity in the UK. And the UK really benefits from very powerful, deep pools of capital, but actually has probably the greatest concentration of expertise around climate tech, sustainability, and the related areas that I think is a huge opportunity for the country.
John, because we're doing a case study, can you talk to a little bit of the timetable from when you find a project, you access private funds, and actually you kind of deliver on the outcome?
Yeah, well, there's a very broad range of experiences. So the quickest turnaround time for a deal that we did in the natural capital space, which was some bridging finance for an outfit up in Scotland, was about 3 weeks from learning about the opportunity to closing a transaction. At the opposite end of the spectrum is a project that we spent 3 years on, and we thought we were there about 18 months before we eventually closed it, and it just took a very long time. It was a new technology, a first-of-a-kind technology, and a market that was very risk-averse at the time. So we do corporate finance, we do project finance. We can be very agile because we're a small organisation. So 3 weeks to 3 years is the best indication I can give you.
But I think, I've worked with national institutions across the whole world. And I have to say, I think the National Wealth Fund strikes a very commercial and pragmatic approach, and one that really does understand around what unlocks further capital in an additional way. So, we've talked about a number of areas that we've executed on, but I think, John, fair to say that we're also thinking about other areas that are currently areas of potential to unlock transition, either growth, new jobs, but there is some kind of market blockage that a partnership can potentially unlock. And I think it's making sure that John understands what the commercial imperative is, and we understand what John's strategic imperative is.
If I might just build on that. So particularly when it comes to climate change, too often you get people in a room and they're trying to persuade each other that their view or their argument or their priorities are correct. And I've done that. But I think the really nice thing about how we got working together was we got in the room together and we said, well, I presented my priorities. Daniel, on behalf of Barclays, presented what they were interested in, and we found the overlap. And all the stuff that didn't match, we didn't talk about, but we just focused on the overlap where that Venn diagram intersected. And there's a big list, and there's more than enough for us to work on. And it just, for me, opened up my mind. I'm not trying to, I don't have to sell the climate transition. I'm not trying to persuade people that our view, or even that the industrial strategy is perfect. Find a private sector partner who's got resources and skills that you think you can leverage, and then do that Venn diagram thinking. Where's the overlap, and just go heavy into that.
But we're here in London Climate Week, and there's going to be a lot of very worthy conversations going on. Ultimately, the biggest difference, I think, for the way that the partnership works is we both focused on executing a transaction. Mm-hmm. Because I think too often there's a lot of great ambition. And actually what we need is deals. And deals need to get done. And once they're done once, other people will do them twice, 3 times. And that's how you scale real change.
We have a question from the audience. Abby.
Yes, we do.
And please keep on sending questions.
Yes, scan that QR code. What does the evidence tell us about long-term energy prices for renewables? Are we buying energy security or bringing down costs for consumers with our investments?
We only have 5 minutes to answer that. We could go on for 3 hours, but we just don't have that kind of time.
I'll give you maybe the 30-second version. One, if you want new power, and obviously the big focus around now is abundant, low cost power. It takes 5+ years to put new gas in. Just the supply chain impact. Nuclear, 10+ years. If you want new additional power tomorrow, that has to be renewables. It's modular, deployable. We've seen the costs of solar come down 90%. Wind 70%, batteries 90%, costs are still coming down. So I think for me, as I said earlier, the UK and Europe in particular wants low cost, affordable power isolated from international markets. Decarbonisation is going to be key.
I'd agree, and I'd plant one thought in people's minds, and you can disagree with me, but I think if you think about the rational response from kind of democratically elected governments, we are all going to slightly overbuild our renewables capacity. And we're all going to invest in connecting with each other so that we can move electrons between each other. And there's a possibility 20 years from now where electrons are actually very cheap. And that could be an enormous productivity boost for these economies. So I just keep that thought as an experiment in your head.
John, just going back to the deals, is there a lot of capital actually chasing the same deals? Can it get overcrowded?
It can do, and we're very disciplined not to be in the room if that's the case. You know, the worst thing, we need to collaborate with the private sector, and we need to be trusted by the private sector. And it's really important that we're not seen to ever elbow people out of a deal. You know, for us to come in with cheap public money and make it harder for private sector actors to do their job or to get their returns is not our mission. Plus, you know, I work for a government that has real fiscal constraints that are well understood. So we go looking for problems and weaknesses, and we do try and get ahead of them, but we're really disciplined about not crowding out.
And this, I imagine, is something that you're very conscious about as well.
Yes, I mean, it's actually not often you sit on a panel about transition and you get a question about, is there too much capital going after this? Normally it's the other way around. So, but no, I think absolutely, I think we're also very disciplined. I think where Barclays can bring real differentiation is creating new structures, looking at risks in a different way and scaling different areas, whether that's in climate tech or securitization or others. There's plenty to do that actually has positive impact and is very capital accretive for the bank.
I mean, not every private capital, you know, is created the same. I'd put it that way, John. So what's the ideal partner?
It's a really important point because, you know, last 4 years deploying public money, having spent 30 years as a steward of private capital, and you know, one of my big realizations is just how rigid the private sector pools of capital are. You know, banks work in a particular way, the insurance sector works in a particular way, often guided by regulation. And what it means is that when you get a challenge like the climate challenge, where you're faced with, you know, decommissioning a high carbon, no longer fit for purpose industrial economy in peacetime with a fiscally constrained government, the status quo probably isn't going to get us there because of these rigidities. So anytime an organization is a bit more entrepreneurial, does deploy balance sheet capital, does invest their skills and their thinking into developing new solutions and innovating, I think we've got to embrace that. We've got to applaud those who are doing it. One of the reasons I'm really happy to be on stage with Barclays today is because they've done just that. But the rigidities, they keep us safe, but when you've got to take new risks to solve a really complex problem, they can be a drag.
Daniel, can you give us an idea of where you think the next, you know, best investment is actually for sustainable finance?
It's a great question. I mean, I think the areas where we are seeing a lot of interest and momentum is around things like the built environment. I think there's a lot of innovation that's coming through around how you can have sort of drop-in technologies that can reduce the cost of heating homes in these sort of areas. Also thinking about retrofitting, I think that's a big area, again, of technology. These sort of hard-to-abate sectors, these transition finance, I think this is where there's a lot of focus around renewables, and that's got scale already. How we go after these other areas where they're high emitters and you want to reduce those emissions, I think is a big area, and we see a lot of really interesting technology coming through.
I mean, things like retrofitting just are so capital intensive at the start.
And I think that's one of the biggest challenges for this whole space is that the capex at the beginning is massive. And so that's partly what puts off a lot of other financiers. And you kind of need to look past that and say, well, there's a big opportunity because if you deliver that retrofitting, you deliver lower costs, lower emissions, more affordability. And that's exactly how that's why structuring becomes really important to that.
John, where do you see the next big thing? Money going to? Is there like a project or a space that looks attractive?
There's lots. I mean, I think we've still got the CCUS and hydrogen economies to build in the UK. So business model design there and revenue support mechanisms and grant pots, etc. So the government has got a lot more to do there. Energy storage to support a renewables grid, both long duration and short duration. I think some really interesting opportunities in the long duration space. Decarbonising the housing stock, one of the more difficult challenges. There's an endless list. We're not going to be bored.
We're out of time, but we have one question. I can't not have a last question from the audience.
Let's do it. And it's going to be another one that you could probably talk about for a long time. But how should we navigate the geopolitics of China being the dominant clean technology provider?
Perfect. In 20 seconds.
In 20 seconds, let's do it.
John?
Embrace it. If we're going to get to net zero by 2050, I think we will be looking back, thanking China for a lot of the technology, the scale, the pace that they've developed and deployed at. I don't think we should be afraid of China in this space.
I mean, I build on that just by saying I think countries like the UK and others can look at where our competitive advantages are. And actually, John's rattled off a couple of really interesting areas around carbon capture, long duration storage. And actually, there are still large areas where the UK and Europe can grow that capability. It doesn't need to compete, it can build upon.